Most investors don't lose money because they pick bad investments. They lose money because they can't stop changing them. That's why investments that are literally set and forget are so important. Now, that doesn't necessarily mean that they won't be volatile or they won't move around. And actually, it doesn't necessarily mean that they'll be the best performing investments. They're just ones that you don't need to worry about. Setting that time frame is so important because it will never feel like a good time to invest. Even in a strong market, it will feel expensive. In a negative market, it will bring you fear. And in a sideways market, it will just feel boring. And that's why the current price will be slightly less of a factor with these decisions. I also don't want to be saying on a video things like, this investment looks good right now, especially with the volatility that we'll likely see over the next few weeks. This is about investments that will be good for at least 10 years, regardless of what's happening right now. And this is a part where I'm meant to tell you not to check your portfolio every day. But let's be honest, we all do it. What I would say though is try not to place trades or make decisions on your phone. After all, the investing platforms are designed to be as easy to use as possible. But by doing something on the desktop, it just adds that extra layer of friction. It might prevent you from rushing into a knee-jerk decision, reacting to a piece of news. But remember, these are long-term decisions that you want to spend a bit of time thinking about. So the framework I've used for this is to think about this from a top-down approach. So I want to pick out themes. So I want to start with either a region, a sector, or a country. And then I want to be confident that theme is still going to be around in 10 years' time. So not just what's popular right now or what's been popular in the last few years, but a theme that you can be confident will still be running in that 10-year period. And then once I've decided the theme, then I can decide how I'm going to get exposure to that. And I can drill down into individual investments. Is it going to be individual stocks, different asset classes, a mix of different funds? What does that look like? First, let's quickly cover off the one that every YouTuber is going to tell you, the Global Index Fund. This is for those investors that don't want to make an active bet, especially from a set and forget perspective. You're not placing a bet on any particular region or sector. You're just betting on the world economy. Using a global fund that's market cap weighted will rebalance regularly. So an area or region that is performing well will slightly move up in the weighting of that fund. I think a lot of people are concerned right now about having such large exposure to the US, and people are looking about how they can reduce their US exposure. That in itself could be your play if that's what you decide, but it also depends a lot on whether you're investing a lump sum or whether you're going to be investing regularly. And remember, this is not just for the next 2 years, this is for the next 10 years. And a lot of people are worried about this AI bubble and relatively expensive tech stocks. But you've got to think, if you're investing regularly, yes, for the next couple of years, it might not be pretty. But if the US is going to go on this path of either moving sideways or slightly down while other regions might outperform, actually that could be a good time to accumulate. And we're thinking in 10 years' time, all the investment that's going into AI now, yes, it's a big risk, it's a big bet, but could that pay off in 10 years' time? That's a decision you've got to make. But when we're thinking about set and forget, just going into a global index fund can never really be a bad decision. So what about the more active plays? It does seem a very apt moment to be talking about defense stocks right now, but just because something looks good now doesn't automatically mean it's going to perform well over the next 10 years. Especially something like defense, it can be very cyclical. It can go through long periods where it's not really doing anything, moving sideways, and then go on these extended runs because it's backed by government defense budgets. Global defense spending reached $2.63 trillion last year. That's an increase in real terms of 2.5%. It should be noted that that's slightly lower than the 7 to 8% growth that we've seen in recent years, but it does continue that upward trend. And what we've seen over the last few days only adds more fuel to that fire. And it all points to governments committing more and more to their defense budgets, especially in Europe. And it's the government spending that really does give me the confidence that this is still going to be a strong theme in 10 years' time. And yes, of course, governments can reduce their defense budgets, but I think countries, and especially in this climate, will be asking themselves, can they really afford that risk? There's a couple of different options to get exposure to this industry, either going down individual company routes, or you could go down a fund route. Looking at individual companies, two that I really like are BAE Systems, which is Europe's largest defense contractor, and RTX, a defense giant in the US, recently renamed from Raytheon Technologies. But if you prefer a slightly more diversified approach, then an ETF that I like is the Han ETF Future of Defense Fund with the ticker NATP. It does include those two companies, RTX and BAE Systems, but you've also got 58 other companies to help diversify it. If you really want to simplify your investing, I have a free ETF cheat sheet you can download. It gives you my favorite ETFs across different regions and makes it really easy to compare. The link's in the description below. The push for clean, reliable energy, especially nuclear energy, has never been as strong as it is right now. The energy requirements from AI data centers continues to be exponential, and that energy production has to be sustainable. I think in the more distant future, we'll see breakthroughs in fusion energy. That's the process that powers the sun, and that could be a really strong theme towards the end of the 2030s. But it's just a little bit too early right now, and it's really hard to get exposure because most fusion energy companies are private and they're startups. But in the meantime, I think there's so much opportunity with nuclear fission, especially with SMR technology. These can be factory built, assembled on site, and they can also be cheaper and quicker to deploy than your typical nuclear reactor. And actually, this could go one step further with microreactors. And because the cost of transporting electricity around a country or a region is so expensive, rather than having a large power plant that then has to distribute across the grid, you could have multiple either SMRs or smaller versions all dotted around the country, powering a smaller area. And so one particular company I think is well positioned for this is Rolls-Royce, especially because the UK government has just recently selected the Rolls-Royce SMR to be their preferred SMR technology. And they hope to have these connected to the grid by the mid-2030s. And with Rolls-Royce, you've also got this trifecta exposure because they're exposed to the aerospace industry, both in a military and civilian capacity, and now also in this nuclear capability perspective. And there's also a second element to this as well. Because these reactors need fuel, they need uranium to run, we could see a similar effect where we've seen, because of the rise in AI, has had a positive effect on precious metals prices because of the requirement for those. We've also started to see an increase in the price of uranium because of the potential need for reactor technology. And when it comes to uranium, a company I really like is Cameco. This is one of the largest and most established uranium producers in the world. Again, if you wanted a slightly more diversified approach, you could look at a couple of different ETFs. The Global X Uranium Fund, with the ticker URNG, gives you exposure to companies engaged in the exploration, mining, and refining of uranium. And you can get slightly more broader exposure using the VanEck Uranium and Nuclear Technologies Fund, with the ticker NUCG. And the third theme is strong dividend-paying companies. And with the first two themes, they were perhaps more performance-led, ones that you can be confident will still be strong themes in 10 years' time. This is more about being confident that this will just keep ticking over in the background. And this is important because you're less concerned about what the market is doing at any given point. You're obviously happy if it's a strong market. If it's a negative market, if you're regularly investing, then that's a plus. But even if you're not, and you're just reinvesting these dividends, at least you're still accumulating units and actually at a cheaper price. And if the market's moving sideways, that boring market that's not really doing anything, if you invested into a typical growth stock that might reinvest more of their profits, you wouldn't actually be getting much of a return at all. At least with a strong paying dividend company, you'd still be getting some level of return through that dividend, whether you reinvest it or whether you have it paid out. And many good dividend-paying companies tend to be essential businesses, ones that can ride out storms. Think utilities, consumer staples, and healthcare. And it's these types of businesses that tend to have less speculative spending and more focus on return on capital. And they tend to have a healthy cash flow, which means they can pay a consistent dividend. This is not just about picking companies with a high dividend yield that might just be a one-off. You want a dividend that can pay a dividend consistently, but also the ability to grow that dividend. Because if you just had the same dividend year on year, because of inflation, you would actually be losing out in real terms. So you want the ability to be able to increase that dividend long term. I think with these types of companies, you have to accept that they'll likely not be the best performers, but they're just ones that you don't really have to worry about. One of my favorite ways to get exposure to good dividend paying companies is through the City of London Investment Trust by Janice Henderson. And this investment trust stands out because it has the longest record of annual increases, 59 years of dividend growth. The other benefit you get with dividend investment trusts is that they can hold back up to 15% of the income. So in good years, they can hold back some of that dividend income to then pay out in some of the poor performing years. So you tend to get a smoother ride from the dividends. You will generally pay a little bit more with investment trusts because they are actively managed, but this one's so competitively priced, has an ongoing charge of 0.36%, and that's very comparative to your typical dividend ETFs. If you did want to go down the ETF route, one of my favorites is the State Street SPDR S&P Global Dividend Aristocrats Fund with the ticker GBDV. This one stands out because it tracks an index that only includes companies that have at least maintained or increased their dividend over the past 10 years. You could look at individual companies if you've got a particular interest and you've done enough research on that company, but I think with this theme, it's just better having a more diversified approach in a fund. Let me know what other themes you may have included down below in the comments. I hope you found that useful. Thanks for watching, and I'll catch you in the next one.